Yeah. So I'd like to highlight first this particular sheet that we have here, what you're seeing on screen. I guess Suraj, when he took you guys through this a few days ago, I think probably 2 or 3 days ago, he highlighted to you that we have analyzed about 70 odd case studies. And here is the summary of what those case studies are. So if you look at this, we have actually tagged each of the case study to the questions that are visible or that have been given in the case study. So if you look at it, DT questions of DT are there roughly in about 23% of the cases, right? So overall, there are about 79 cases. DT is covered in 23% of the cases. FR is covered in 18. IDT is covered in 16. Company law, when I refer to company law, excluding your economic laws like FEMA and other stuff, is covered in about 16% odd cases. Then auditing 12%, economic loss, FEMA and other stuff in about 6%, AFM 3%, and SM and SCMP 2%. So AFM and SCM and SCMP are the big surprise here. However, I wish to tell you one thing, guys. If you look at what I'm highlighting on the screen now, this refers to November 22 question paper. November and May 22 question paper. If you look at the May 22 question paper, right, there are about 5 cases of which there's only one case in which there was a DT question. Okay, balance all cases did not have a DT question. So institute is very much capable of these bouncers and googlies. But nevertheless, what I got a feeling after going through all this analysis is DT is a very, very important topic. And therefore, and of course, FR and IDT in that order. And then finally, of course, corporate law. Right. So now our intent in this particular IBS cases, what we are going to do is get you a good flavor of all these cases. We've solved one case last week or so. We're solving second case today, and we also are planning to launch a paid course on IBS, Integrated Business Solutions Case Studies course. The classes will commence from 15th of March. So 15th March is when the classes will start, and these classes will be available on our platform. These classes, we will be launching this course probably in sometime in next couple of days. So do stay tuned to our channel, and you will be able to enroll in these classes on our website. But the classes will start on 15th of March 2024. They'll go on for roughly about 40-45 days. And where we will try and cover as many case studies as possible, and we'll also provide some PDF notes. Please note, we are providing PDF notes along with the classes. The classes are going to be very, very affordably priced, and the classes will be conducted in the same manner in which they are currently going on, in the sense that we'll have various faculty coming in and having a look at going through the case study live along with the students, and then answering questions which pertain to their subject. So we're going to launch classes on 15th of March. So please take note of that. And of course, we are going to provide this analysis, whatever we have, to our paid students. Right. So without further ado, let me now move to the all important thing of case study for the day. So this is the case study. This is a case study from the ICAI new material. This is case study number 1. So the way we will work on this particular case study is I'll read through the case. It's a fairly precise and rather brief case. So I will read through that, and wherever required, I'll seek intervention of my colleagues Shivdeja and Ashlesha, and they will also be joining in as we read through. And then we'll go and look at the questions. But please note, my dear friends, as was very, very specifically highlighted in the previous discussion, when you get a case study, first thing is have a glance at the case, see how big is it. So in our case, it is roughly about 1.6 pages. Then directly jump to questions. And please don't answer the questions. Just go and have a look at the questions. So the first question, somebody has invested some money. Which of the following is most appropriate about arbitrage funds? Right. So now this looks like a question from AFM. Second question, P is of the view interest rates in economy are likely to rise. What is the impact that would have on a debt fund? So this is also again AFM question. Then there's a word called TDS. So this is a question from income tax. Then there is a question on TDS again. This is also a question from income tax. Now moving to fifth one, liberalized remittance scheme, very clearly FEMA. Right. Then you have descriptive questions. Tax implications is the word that should catch your eye. Then number 7, what are the tax implications on redemption? Again, this is the word that should catch your eye. And last thing, FEMA. So you have to do all of this in a matter of first 3 to 5 minutes. Go through very, very briefly. I'm not asking you to solve anything. Just go through so that you actually get a sense of comfort. Please don't directly jump into the case and start reading the case. That actually is not the most preferred way of doing it. I have written CAT where and got a very decent score. Even in CAT, when we are given very lengthy case studies, this is the way people do it, right? You don't jump into the case. You actually jump into look at the length of the case, have a very, very brief glancing look and jump directly to the questions, have a look at the questions and then come back to the case. And then when you look at the case, you learn to ignore irrelevant aspects, right? So let me go with the case and then let us start off. All right, let me zoom in as well. Yeah, so the case goes here. CAM has a flourishing practice spanning in areas of auditing, taxation, both direct as well as indirect consultancy, particularly in forex laws in Chennai. His clients include many HNIs apart from corporates and non-corporates. Okay, great. None of this is actually pretty useful. One day, one of his clients, Mr. P, called him to inquire about tweaking of certain rules pertaining to taxation on redemption of mutual funds. Okay, taxation on redemption. So this is the key thing. He has heard that redemption for certain type of mutual funds is now going to attract increased income tax payouts. He has also heard news of the same on BTBC news channel, irrelevant, but was unable to comprehend it lucidly. What is lucid? Lucid means clear. Okay. So I'm sure that, ICI will use some of these, fancy language. Please don't bother about it. Just go ahead with the case. Okay. There was no clarity to him whether changes have been made in income tax rules or in rules framed by SEBI. Relay Consultancy, and AMFI. What is AMFI? Association of Mutual Funds of India, registered mutual fund distributor through which mutual fund investments were made, was continuously forwarding messages received from AMFI in his mobile. The messages were at best cryptic, meaning confusing, and required investors to be in touch with their CA or tax consultants. All this so far is only story. There is actually very little essence. Essence is somebody has mutual funds, he is looking to redeem them, and he has some tax issues on them. That is a one-line summary of entire 3 paragraphs what we've read. Now comes the next part. Mr. P has an impressive investment portfolio of 50 crores relevant in various mutual funds, and any changes in income tax payouts pertaining to it could affect his ROI adversely. Under stress, he sought for an immediate appointment with Mr. C, with the CAM, and armed with a summary of investments made in mutual funds, he came to the office and sought his much-needed advice. The summary of the mutual fund investments is as on 31st March 23 looked as under. Again, lot of gyan, very little stuff. Portfolio values 50 crores. That's all. So what are the investments? MLT low duration fund, date of investment. So Shiv Teja, you want to highlight something here? You can unmute and proceed, please. Shiv Teja?
Yes.
Hello. Yeah.
Yeah. So, my dear students, but one thing very important is that when you look at this kind of situation where they're talking about mutual funds, it is important that you look at whether they are debt-oriented mutual fund or equity-oriented mutual fund. By looking at the question, you need to observe that point, because I'm sure you guys know that in case of equity-oriented mutual fund, if it is more than 12 months, we call it as long-term, less than 12 months, we call it as short-term. But when you talk about debt-oriented mutual fund, we look at 36 months angle to decide whether it is long-term or short-term, because ultimately the tax rate for long-term and short-term is very much different. So that's why you need to be very cautious with that particular point.
Okay. So there is something called low duration fund, and we are looking at as on 31st March 23. Date of investment is 3rd April 20. Okay, please note the date. It is not more than 3 years, less than 3 years. Then amount invested 10 crores. Bond India low duration fund 12th December 20, again less than 3 years. ABD Green Energy Fund 2nd December 2022, so less than a year, 15 crores. SBI Life Arbitrage Fund 8th November 2021. So this is probably more than a year, but less than 3 years, 10 crores. So 10 plus 15, 15 and 10 adds up to 50 crores. Besides, he had also invested 5 lakhs in a liquid fund. Since amount invested was small, he was not bothered about the same. He also informed to CAM that funds stated at 1 and 2. So 1 and 2 are MLT low duration fund and Bond India low duration fund are debt funds, and the funds stated in 3 and 4 are equity funds. So first 2 debt, next 2 equity. Why is this important? From a tax perspective, as Shiv Teja just mentioned. He further informs that these debt funds have 30% of their proceeds in equity shares of domestic companies. So debt funds have 30% equity, and equity funds have 70% of their proceeds in equity. So debt funds are 30-70 debt and equity, equity and debt, whereas your equity funds are 70-30 equity and debt, right? Then investment pattern of the funds is going to remain the same in upcoming years. He was planning to redeem his entire portfolio in the month of October 23, tentatively depending upon suitable market conditions. Their discussion also weighed towards returns from debt funds. Debt funds invest predominantly in government and high-grade corporate bonds. Mr. P was of the view that interest rates in economy are likely to go up. Please note this word, likely to go up, in few months' time, keeping in view broad macroeconomic indicators. The discussion stretched a bit and it came out that he plans to buy a villa in Goa. See, this is a very important point. He's already 65 years old and wants to spend quality time in scenic beauty of Goa. In fact, it transpires that he's going to make an advance payment of rupees 1 crore to the owner of the villa, Mr. Christopher, an Indian citizen who's also non-resident. The non-resident owner of the villa had acquired his ancestral property through registered will of his late father. The total consideration to be paid to Mr. Christopher amounts to 5 crores, including advance payment of 1 crore. So far, what have we learned? He has some portfolio and he wants to redeem this particular portfolio, right? He sought for, there was a bunch of impressive portfolio. He wanted to meet the CA, and after meeting the CA, he also told that he wants to redeem and he wants to buy a villa in Goa. And the person who's selling the villa also has some complication, he has received it as a, registered will from his father, ancestral property. In fact, he is also one of the reasons for planned redemption of mutual funds in current financial year. He inquires from CAM regarding precautions to be taken, the legal requirements to be complied with at the time of entering such transaction. Mr. P also discusses the matter with Christopher over phone, who happens to be in India at that time for a short visit. So, see, they have purposely given all these names, M, Christopher, P, and all that. You should not get confused. The CA is M. Christopher, P is the person whom we are talking to, the client of Mr. M, right? Mr. P, right? He's the client of Mr. M. Then Christopher is the person who's selling the villa, right? Fair enough. Shivdej, you want to take it from here?
Yeah. So you have to understand one point here that Christopher is a non-resident who is basically outside India. So the moment you see that word non-resident, your provisions related to non-resident taxation should immediately strike to your mind. That's very important there. So I'll take it from here there.
Yeah, so please go ahead.
He in turn also inquires from CAM regarding investment avenues, if any available to non-resident, like purchase of the house, investment in NHI bonds. The moment you look at purchase of a house, he basically sold some mutual funds and he's going to put that money in purchase of a house and also in purchase of NHI bonds. Your capital gain exemption should immediately strike your brain. That's very important. Under taxation laws, to save capital gains tax and also requirements pertaining to filing of income tax return. It also transpires that India does not have DTAA with the country of Mr. Christopher, who is a resident of that particular country. So that's an interesting line. Yeah. And I think, Ashleisha ma'am, I think you can talk about the last paragraph.
No, I think last couple of lines. Mr. Christopher plans to repatriate the proposed proceeds of sale proceeds of villa to his country in which he is a resident. He does not know the modalities of the same and inquires from CAM in this matter. So CAM has now got bumper offer. One client, Mr. P, and client's vendor, villa seller, Mr. Christopher. Okay. So both the things he is asking. So Ashleisha, please.
Yes, so when you read the last line, it talks about repatriation of sale proceeds. So as soon as you look at this, something should come into your mind, that is Mr. Christopher is a non-resident and he wants to repatriate funds. Will the liberalized remittance scheme be applicable here or not? So the residential status will play importance not only for tax purposes, but also when you answer the question according to FEMA. So we'll look at the questions ahead and see how the residential status will have an impact on our answers.
Absolutely. So let me take the first question. Mr. P has invested 10 crores in SBA Life Arbitrage Fund. Is that what they said? SBA Life Arbitrage Fund, 10 crores. Great. Then, which of the following statements is most appropriate about arbitrage fund? So guys, if you remember our mutual funds chapter, so please note, this is theory aspect of mutual fund chapter. So when you're preparing for case study exam or this paper 6, you have to know a lot of stuff about theory aspects of the various subjects. You cannot say that, I will just study the upper say something, I'll remember some rate and go away, right? So this is a very fine aspect of arbitrage funds that is discussed in the mutual fund chapter. Now, what are they asking? Which of the following is most appropriate? Meaning which is right? Right. Such funds tend to provide better returns than equity. However, they have lower volatility in comparison to equity. Besides, they seek to capitalize on price differential between spot and futures market. Expense ratios in arbitrage funds are likely to be lower as compared to liquid funds. Now, they are making 4 statements in a single point, and they're asking you, even if one of them is wrong, this particular, option A is wrong. So we just have to search for which is wrong. Okay. If there are 4, even if one is wrong, good. So let us see which one is wrong. Expense ratios in arbitrage funds are likely to be lower as compared to liquid funds. That is wrong. Why? Liquid funds deploy money in debt instruments and money market instruments. So when they deploy money in debt and money market instruments, there is no exact massive allocation activity that happens. Expense ratio will be higher when you have a massive allocation activity, like you have to do a lot of research to figure out which company to invest, what is the equity stock, mid cap, small cap, and all of that. So that particular statement is entirely wrong. So you can actually reject point number 1. But let us look at other points. Such funds tend to provide better returns than equity. No, that is also wrong. Why is that wrong? Equity, typically, large cap equity or multi-cap equity or flexi cap equity or, your mid cap, small cap. These all funds are typically the best performing funds across the world, not only in India, across the world. They are typically the best performing funds. So point number 1 is also wrong, right? An arbitrage fund does not provide better returns than equity. It is one level lower than equity, but it is one level higher than debt. However, they have lower volatility in comparison to equity. There itself, we should strike, how can something provide better return and have lower risk? That is impossible, right? If risk increases, return increases, or return increases, risk increases. So it is very clear that point number 1 is incorrect. But in point number 1, this other point is right. Which is what? Besides, they seek to capitalize on price differential between futures and spot market. Even if you don't remember what is an arbitrage fund, if you see this line, right, it should strike you that this is what is an arbitrage fund, something that focuses on price differential between spot and futures market. So let us move to the second option. Such funds tends to provide better return than debt. This is exactly what I said. It is higher than debt, lower than equity. However, they have higher volatility in comparison to equity. Wrong, right? If they are better than debt, right, then they are one level higher than debt, but then how can they have higher volatility than equity? That is also wrong. Besides, they seek to capitalize on price differential between spot and futures. So that is given, right? Expense ratio are likely to be higher as compared to liquid funds. They tend to be higher as compared to liquid funds because there is some amount of activity that is involved. Let us look at point C. Such funds tend to provide better return than debt. Yes. They have lower volatility in comparison to equity. That is also yes. They seek to capitalize on price differential between spot and futures. That is also yes. Expense ratios are likely to be higher as compared to liquid funds. Yes, absolutely yes. So all 4 points are right in point C, which is why we answer for this is point C. Let me just look at point D. Such funds tend to provide better return than equity. No. They have higher volatility in comparison to equity. No. They seek to capitalize. That is the same point. Expenses are likely to be lower as compared to liquid funds. No. So point D is not correct. Only point C is correct. So answer is option C. Next question is, Mr. P is of the view that interest rates are likely to rise. What happens when interest rates rise? What likely impact would it have on NAV of a debt fund? So debt fund invests in debt instruments. Debt instruments are fixed income instruments. When interest rates rise, the present value falls. When interest rates fall, present value rises. So in this case, if the interest rates are going to rise, then the debt fund's value will fall. So the NAV will fall, right? So answer is, it is likely to lead a fall in NAV of the debt fund. Absolutely right. That is the answer. It cannot lead to a rise in NAV. It will not remain the same. Is not affected by movement. All of them are wrong. See, also they said ignore other factors like duration of the bonds and all of that. It's a fairly simple question. There is nothing complicated in it. Answer is option number 2. It will likely lead to a fall in NAV. Going forward, I think this is a question for Shivdeja. Shivdeja, please.
Yeah. With respect to third question, if you look at, my dear friends, it talks about, as regards proposed purchase of villa in Goa from Christopher is concerned, which of the following statement is likely to be correct as regards deduction of tax at source TDS is concerned? Assume that he does not have any other taxable income in India except capital gain from proposed sale of villa. So whenever a question like this comes, where you need to choose which statement is correct, that is where you need to understand that you have to look at your options and then understand which one is not correct and then eliminate that and choose the right option. So let's look at the first one. Mr. P is required to obtain TAN. That is, the P is nothing but the buyer. He is required to obtain tan. That is absolutely true. But the point is, they told that TDS is required to be deducted at 1%. That is absolutely not correct. Because whenever we procure a property from non-resident, we are not supposed to do 1% TDS. 1% TDS is only when we buy a property from a resident, which is more than 50 lakh rupees, we do 1% TDS. Section 194 IA. I'm sure you know about it. And now that we are talking about purchase from non-resident, 194 IA will not come into picture. 195 would come into picture. And B option, it is not mandatory for P to obtain tan. That point itself, this option is ruled out because it is mandatory for the buyer to obtain the tan. Third point, it is not mandatory for P to obtain tan. That point itself, this option is ruled out. Do not waste your time by reading the balance part of the story. Let me proceed. Yeah. Fourth one to look at, P is required to obtain tan. Absolutely true. Application can be made to assessing officer for determining the capital gains on which tax is to be deducted. In that case, TDS will be deducted at lower rate after determination of capital gains by AVO in the international wing. And if lower deduction certificate is not available, TDS will be done at the rate of 20% because it is long term. His ancestor has procured the property. However, TDS will be deducted at the time of making advance payment as well as at the time of making the balance payment. Very true, because TDS will always be done at the time of payment or at the time of credit, whichever is earlier. That's the reason why option D is the perfect answer for this particular question, which talks about TDS on purchase from Mr. Christopher. Moving ahead, my dear students. Fourth question. As regards Christopher inquiry regarding purchase of another property, that is residential property, and investment in bonds of NHAI and filing of income tax return, which of the following statement is most appropriate? Before I proceed to that options, let me tell you, my dear friends, when he's procuring another property, residential property in India, and he is selling mutual funds, he can definitely take exemption under capital gains under section 54F. And at the same time, when he's buying bonds of NHAI, he can very much take the exemption of 54EC, my dear friends. So let's see the options. Option 1. Non-resident can make above said investments in to save capital gains tax. However, after making investments, if he has no taxable income, there is no obligation to file return. That is wrong because he has to file the return. Section 139 subsection 1 clearly says that if any individual's total income before claiming exemption under section 54, 54EC, 54F, 54B, 54G, 54GA, 54GB, before claiming exemption under those sections, if it is more than basic exemption limit, then they are required to file return of income. Look at the next option. Non-resident can make above said investment to save capital gains tax. However, if total income before giving effect to deduction against such investment exceeds basic exemption limit, there is an obligation to file return. Absolutely a valid point. But still, for the sake of convenience, let's look at the C option also. Non-resident cannot make investments. That is ruled out. Even though he's a non-resident, still he can take the exemption. Let's look at option D also once. I'll just scroll it further, Srina. Yeah. Non-resident can make investment by purchase of another property, but cannot make investment in bonds of NHAI. That is also gone. So the best suitable option is option B, my dear friends. You might get one doubt, just to clarify, my dear students, that you might think, sir, once you got answer B as correct, why did you look at C and D? The reason I'll tell you why. Because sometimes what happens is that in exam, they'll ask you, choose the most appropriate answer. So there could be situations where four options are appropriate, but we need to signify and identify which is the most appropriate option. That is why I always suggest go through all the options before you come to conclusion. We are CFNS students. We cannot jump into conclusion just like that. We need to be very cautious.
Students, before I hand over the thing to screen to Aslesha, if you have any questions, please do type it in the chat box. Feel free. We're more than happy to respond to these questions. So please feel free to type in these questions, whatever questions that you have or any doubts or anything, we're more than happy to answer. Okay, Aslesha, I think you can
feel free, my dear students. It's all for your benefit that we have planned this. So I think the more you participate, the more wonderful it will be. Thank you so much. Yeah, sorry, ma'am. Please go ahead.
So the next question talks of Mr. Christopher. If you remember, Mr. Christopher was the third person who had come in the case study who was a non-resident. Mr. Christopher, he plans to repatriate from India the sale proceeds of villa. So he's selling the villa and whatever sales proceed he's getting, he plans to repatriate that outside. He plans to repatriate that outside India. So which of the following statements is most appropriate in this regard? Now, when we talk about repatriation, the first thing which should come to your mind is remittance options which are available. Now, there's one scheme which is called as the liberalized remittance scheme, but this scheme is applicable only to resident individuals. And let's now have a look at the options and see which option is the most appropriate one. So option A says proceeds up to USD 2,50,000 can be repatriated in financial year by using liberalized remittance scheme. So as soon as you read this liberalized remittance scheme, it is not applicable to Mr. Christopher at all, because Mr. Christopher is a non-resident and LRS is applicable only to resident individuals. So option A is not the correct one. Moving on. Option B again has a mention of liberalized remittance scheme. So again, that is also not the correct option. Moving to the next one, it says proceeds can be repatriated using NRO account subject to certain restrictions in a financial year. Let me tell you what an NRO account means. So NRO account is basically an account which is held by a non-resident individual, and that account basically has the proceeds of income which he's earning in India. So basically incomes arising in India are there in his NRO account, and now he can repatriate the funds from NRO account. However, there are certain restrictions on it. He cannot freely repatriate, or he cannot freely remit all the funds which are present in his NRO account. There are certain approvals which are required, and also there's a certain limit which has been set. So option C seems a correct option because it does not mention anything about liberalized remittance scheme. Let's just have a look at option D and then we'll conclude on the correct option. So option D again has a mention of liberalized remittance scheme, which is again not applicable to a non-resident, which gives us our correct option, which is option C. FCRA will not be applicable here in this particular situation. This is a question based on repatriation, wherein we'll apply the provisions of FEMA.
Correct. There was somebody else also who had asked a question. Just a second, I'm trying to locate that question. Or I think, was it in YouTube? In YouTube, one student said, students should have knowledge of other subjects to attend the IBS, which you said you will launch in some days. Somebody's asked this in YouTube. Yes, they should have some basic knowledge. If they don't have basic knowledge, it will be very difficult. We will be providing, some content with respect to, other subjects. But if you don't have basic knowledge of other subjects, it is very difficult. Okay, this is an answer to a question that has been asked in YouTube. Coming back, Shivteja, I think next is yours, right? These are descriptive questions.
Yeah, can I share the screen for a minute?
Yeah, please, you take over the screen. I have no problem. Also, one person is asking, sir, is it true that 40% approximately will be from SCMP in IBS? Are boss, just now I showed you something. Shivteja, just 1 sec.
Yeah.
So, somebody has asked this question, 40% question, no? So, we have analyzed case studies of about 79 odd case studies. Okay, this includes from case studies from suggested answers of December 21, May 22, November 22, November 23, May 23, and all of that, and old syllabus paper 6F elective case study digest, and the latest RTP, then latest student journal, and latest material 15 questions. Looking at all of this, there is one thing that we came up with. Income tax is roughly 23% of all questions. FR is 18, 16% is IDT, law is 16, auditing is 12, economic law is 6%, AFM is 3, and SCMP is 2%. Now, I don't know where you got this number of 40, but we are not seeing this 40 in any of the cases that have been given by the institute. However, having said that, the institute is very much capable of bouncers. So I will show you one such bouncer, which is showed in the beginning of the session. If you look at May 22 paper, out of the 5 questions, case studies that were given, 4 case studies did not have even a single question on income tax. I am saying this after telling you that income tax is very important, right? So institute is very much capable of these bouncers, but I very much doubt that 40% of the content is going to come from SCM, strategic management or SCMPE, because they have to cover 6-7 more subjects. So at the most 15%, 20%, not beyond that. But that also looks very unlikely from SM or SCMPE. Most likely, they will follow this pattern. 20-25% from DT, FR 15-20%, IDT 15-20%, and so on and so forth. Right. So this is the summary. Shivteja, over to you again. You can please take.
Yeah, thank you. Yeah, I hope the screen is visible.
Yes, yes.
Yes.
Yes, thank you so much. Yeah, the fundamental reason why I wanted to share the screen was something like this. If you look at the initial part of the question, they were talking about completely about the funds. Now look at this interesting question, guys, what they're talking about. Since P wants to redeem his entire portfolio in October 2023, you have to understand that he's intending to redeem everything in October 2023. What should be the advice of CAM to him regarding income tax implication of such redemption? Do not calculate tax liability. Please note that they didn't want you to calculate tax liability. Just describe the manner of taxation and the rates, ignoring surcharge and cess. What further advice he should offer regarding the news heard on TV or messages received on mobile? Now, let me take you back to the question, my dear friends. If you observe, my dear students, very clearly, there are 4 types of fund what has been given. And in that 4 funds, the 1 and 2 are debt funds, wherein in these debt funds have invested 30% of their proceeds in equity shares of domestic company. And 3 and 4 are equity funds, which invested 70% of their proceeds. There is a provision which clearly says that if you invest minimum of 65% in equity shares, then we'll definitely call it as equity-oriented mutual fund. We'll definitely call it as equity-oriented mutual fund, where the period of holding to determine long-term and short-term that will come into picture is only 12 months. Now, when the investment is 3/4/2020, and they're saying that they're planning to redeem in October 2023. So what has happened is, first case, it is definitely going to become long-term. Second case, 12/12/2020. So this case is going to definitely become short-term. This case long-term because it is more than 36 months. This case it is short-term because it is less than 36 months. And here it is long-term, my dear friends. We will tax at the rate of 20% under section 112. And in this short term, we will tax at slab rates. That is nothing but your normal rates applicable, because there is no special rate of tax in case of debt-oriented mutual fund. But the third and fourth point, you have to observe that they are equity-oriented mutual fund. And here they told 2/12/2022. And when they're planning to redeem, they're planning to redeem in October 2023. So this is definitely going to become short term. Now, even though it is short term, we'll apply the provisions of section 111A and we'll tax at the rate of 15%. Because 111A clearly specifies that short-term capital gain on sale of equity shares or units of equity-oriented mutual fund or units of business trust through recognized stock exchange on which STT is paid is taxed at the rate of 15%. Now, in the same line, for the next point, 8/11/2021, that is definitely going to become long-term because it is more than 12 months. And when it is long-term, we are going to apply provisions of section 112A. And 112A says long-term capital gains with respect to equity-oriented mutual fund, we are going to tax at the rate of 10%, that too on amount exceeding 1 lakh. So that is what is the whole expectation, what they are asking in that particular question, where they have asked very clearly, what is the tax implication? That is what I just discussed with you. What is the rate of tax? That is what I just discussed with you. Next part, they ask, what further advice you should offer regarding news heard on TV or messages? There is nothing, because the TV or messages, whatever news has come into picture, that is relevant only for specified mutual fund which are acquired on or after 1/4/2023. On or after 1/4/2023, there is an interesting provision which has come up known as section 50AA. In fact, next question, if you look at, that is what it talks about actually. You can see the next question. Mr. P has also plans to invest further amount of 10 crores in MTL low duration fund and Born India low duration fund taken together in 23-24. What is MTL low duration fund and Born India low duration fund? That is nothing but 1 and 2, I believe. Exactly. So there is nothing but 1 and 2 funds. Now, when it is 1 and 2 funds, they are nothing but debt-oriented funds. And you have to observe that these debt funds invest 30% of the proceeds in equity share. Section 50AA says, in case of in case of specified mutual fund, wherein the mutual fund units are acquired on or after 1/4/2023, and specified mutual fund is that mutual fund which invests not more than 35% in equity shares. And this case, it is a specified mutual fund. And section 50AA specifies that capital gain arising on transfer of specified mutual fund shall be deemed to be short term. They are not regarded as long term, even though the period of holding is 12 months, 36 months, it doesn't matter. It is deemed to be short term. They're asking what are the tax implications on redemption of above investment after holding it for more than 3 years. So what? Even though it is more than 3 years, still it is regarded as short term. Assume that tax law applicable in 23-24 remains unchanged at the time of redemption. That is what we are talking. But in sixth question, you should not talk about it because they are not specified mutual fund. Specified mutual fund covers only that units which are acquired on or after 1/4/2023. So this question is a straightforward question related to amendment in capital gain given by section 50AA, a very interesting section. Yeah, that's about tax.
Let's move on to the last question. I'll share my screen. So the last question is very simple. Just talking about Mr. Christopher. It's talking about Mr. Christopher, who is a non-resident and he's planning to sell his villa in Goa. Now, examine the validity of transaction with respect to FEMA 1999. So here the question comes in that Mr. Christopher, being a non-resident, can he sell his villa in Goa? Now for this, let's go back to the case study and see that how did he acquire the villa and when was the villa acquired? So if you look at this point here, so the villa is located in Goa and the villa he has acquired this as an ancestral property through the registered will of his late father. So here, Mr. Christopher, though he is a non-resident, he has acquired the villa as an ancestral property from his father, and this is from a registered will. Now, if you know that there's a section in FEMA which says that a PROI, that is a person resident outside India, can hold, transfer, acquire any Indian currency or any other property, immovable property, which is situated in India. However, there are two conditions in it. One is either at the time when he was a resident in India, or the second is that he should have inherited the property. Now, in our situation, the case is of inheritance, which means that Mr. Christopher can validly hold the property. And being a PROI, he has also got a right, according to Section 6 of FEMA, that he can transfer the immovable property which he has inherited from his late father. So in this situation, the question is asking us about the validity of the transaction. So first, you will have to write down the provision of FEMA which you are using, that is Section 6, wherein we say that a person resident outside India, he can transfer immovable property which he has acquired by way of inheritance from his father. So this transaction in this particular situation is valid because Mr. Christopher, he has acquired the property as it is an ancestral property and he has acquired it by way of will from his late father. So the transaction which has happened is a valid transaction. So that's it. It was a very simple question.
Okay.
I would like to add just one point here. That is, friends, with respect to tax, I specifically want to tell you that. I'm audible, right?
Yes.
Yeah, of course.
Yeah. So friends, with respect to tax, I specifically want to tell you that whenever you read that question of the case study, it is important that you need to highlight and get the thought which section and provision is coming into picture. See, ultimately, we all know that we are going to look at the book and everything, but the whole point is all about we should be able to understand which one to look at. So for that, when we look at the case study, we should be in a position to identify which provision and section is coming into picture. So for that purpose, having a thorough knowledge on the concept is very much required, which comes by sheer practice, nothing else.
Okay.
Yeah.
Okay, great, guys. Thanks a lot. Somebody's posted a question. What is the question? Audible. Okay. So, guys, so this is the, thanks a lot for attending this case, discussion. We have, classes starting from March 15th. Please stay, updated on our website and app. You'll get a notification once we launch the classes. As I said, it will be affordable. We will give you PDF notes, and the classes will be held on Zoom. We will, be providing you solutions for cases. We'll be discussing. We'll be considering various aspects. Obviously, because this is a free class, the interaction levels probably are slightly lower. Once a paid class comes in, probably students also, we will be taking live questions and so on and so forth. Right. So March 15th classes start. We will be launching the classes on our website in a couple of days. So looking forward to a lot of you enrolling with us. And I would like to thank Shivteja and Aslesha for taking time out and in this session. Just one more point. These classes will be held towards the evening, most likely 7 o'clock or 8 o'clock every day. So a lot of you who are writing first attempt or second or third attempt also can take these classes from us, because they'll be easily available, or you can actually attend classes after your if you've not yet taken leave from your articleship or leave from your office, right? What is the question? Will there be revision classes for direct taxation from IL? So I think we're going to launch some revision batch, right, Shivteja?
That is for CA Inter, which we have announced, but CA Final we have not yet announced.
Yeah, correct. For CA Final, CA Inter, there are some revision classes.
So there is something we'll just get back to for CA Final direct tax also. But let me tell you one thing, since you've asked that question, that is, when you're talking about this IBS case studies, we'll ensure that every day, whatever case study we are discussing, in that particular, for example, any section of provision comes up, we are definitely going to talk about sections in and around that content and talk about it totally, so that you get a holistic learning. And we'll ensure that we'll give some sufficient time to answer all your queries. That responsibility is taken for sure.
Okay. Okay. Great. Thanks, guys. Thanks a lot. Appreciate your time and appreciate the time of the faculty. So those of you who have participated, appreciate your time as well. Thank you and see you.